Hey, everybody, it's me, Buffy the Race Slayer. And yes, I'm back with another episode from our weekly Market Insight series that comes to you directly from our capital markets trading desk right here at SunWest Mortgage Company. So let's just get into it. Markets remained stable through Thursday. Treasury yields leveled off after rising late last week, while stocks showed little movement as investors largely shrugged off economic and political developments. In his keynote speech from the Jackson Hole Summit last Friday, Fed Chair Jerome Powell indicated the central bank could begin easing monetary policy as early as next month to support a weakening labor market. He pointed out that even as concerns about inflation remain, the growing risks to the economy, especially the labor market, may warrant a reduction of interest rates. Following Powell's remarks, expectations for a quarter-point rate cut in September at the FOMC meeting jumped to about 84% from 75% earlier in the week. The U.S. economy grew more than initially estimated in the second quarter. The Commerce Department reported that GDP expanded at a 3.3% annual pace compared with an earlier estimate of 3% after contracting 0.5% in the first quarter of this year. The rebound followed the first quarterly contraction since 2022, driven largely by companies rushing to import goods ahead of an anticipated tariff hike. The expectation projects the economy to expand at a modest pace as consumers and businesses adjust to new trade policies. The Conference Board reported that its Consumer Confidence Index edged down by 1.3 points to 97.4. The decline was driven by growing unease about employment prospects. The Present Situation Index fell to its lowest level since April after dropping modestly to 131 in August from 132 in July. Meanwhile, the Expectations Index fell by 1.2 points to 74.8, remaining significantly below 80, the marker that can signal future recession. MBA mortgage applications decreased by 0.5% for the week ending August 22nd. The refinance index had a week-to-week drop of 4%, but was still up by 19% annually. Purchase applications posted their strongest performance in over a month, rising 2% from the prior week and were 25% higher than the same week last year. The average 30-year mortgage rate inched higher to 6.7% from 6.6% during that period. U.S. home prices continue to rise at a slower pace for the fifth straight month in June. The S&P CoreLogic Case-Shiller National Home Price Index rose 1.9% from a year earlier, the smallest gain since the summer of 2023. Coming in lower than annual consumer price inflation, the low rise of home prices is a sign of a cracking housing market where prospective buyers are holding back due to economic uncertainty and high mortgage rates. July new home sales fell by less than expected after dropping by 0.6% to an adjusted annual rate of 652,000. Forecasts call for a 630,000 pace. The pace of new home sales was also down 8% from a year earlier. While sales topped projections, the new home market has grown increasingly reliant on price reductions and buyer incentives to offset the drag of high mortgage rates. The share of home builders offering discounts and other incentives to attract prospective buyers reached a 5-year high of 66% during the month. The median new home price fell 5.9% year over year to $403,800, while the supply of new houses for sale was at a seasonally adjusted estimate of $499,000, up from 7.3% from a year ago. Signed contracts to purchase existing homes fell more than expected in July. The National Association of Realtors said that pending home sales decreased by 0.4% in July from June to 71.7 as potential buyers took a step back amid elevated prices, borrowing costs, and a slow labor market. The median estimate of economists projected a 0.2% drop in July. Pending home sales fell in 3 of the 4 regions of the country from June, rising only in the West. Even with the monthly drop, pending sales were still up by 0.7% from last year. And new orders for durable goods fell by 2.8% in July after sinking by 9.4% in June. The decline of 2.8% is less severe than the forecasted drop of 4%, but it was the third time in 4 months the metric registered losses. Excluding transportation orders, new orders were up 1.1% in July after a 0.3% gain in June. The value of core capital goods orders, which exclude volatile sectors such as transportation and defense, also increased by 1.1% last month. after a revised 0.6% decrease in June. Applications for U.S. unemployment benefits decreased slightly last week, indicating that layoff activity remains subdued as employers retain workers. Initial claims shrank by 5,000 to 229,000 in the week ending on August 23rd. Continuing jobless claims declined by 7,000 to 1.9 million during the week ending on August 16th. And well, yes, my friends, that is it for this week. I know it was a lot to take in, but please make sure if this video is informative and you want to stay updated on current market news, please hit the like button, share this video, and subscribe. Also, go ahead and tap that notification bell so you are alerted when we upload a new video. Well, guess what? Yeah, it's the weekend. So have a safe and fun Labor Day weekend, everybody. Buffy out.